Okay, so this is absolutely nuts. After a huge week in politics, Trump has decided to get in on the affordability conversation, tweeting the idea for a 50-year mortgage. Now, I've been a landlord for over 5 years, and before anyone comes for me in the comments, I only have multifamily homes, which by definition require a landlord. So that's that. But as someone who both makes a living off real estate and also cares deeply about economic mobility, it's what this entire channel's about after all, I think this deserves a real conversation. So in this video, let's break down the actual math behind a 50-year mortgage, what it'll mean for people who want to become homeowners and build wealth, and my honest take as someone who straddles both worlds. So let's start with where this all began, the 30-year mortgage. A quick bit of history that explains where we are today. This was created in the 1940s as a way to help stabilize the housing market and finance the build and sale of new homes after World War II. By the 50s, it became essentially the default path to the white picket fence version of the American dream. Today, over 90% of home purchases are financed with these 30-year mortgages, and for good reason. Even though there are other options out there like 15-year terms, adjustable rate loans, interest-only mortgages, and so on, the 30-year mortgage has become the gold standard because it hits this sweet spot between affordability, stability, and government support. But here's the part that most people don't realize, that your interest payments are front-loaded during the beginning of your repayment plan. With any mortgage payment, your money is getting split into two parts. There's the actual principal, which is the amount that you borrowed, and then there's the interest or fee that the bank is charging you to borrow it. In the beginning, most of your payment goes towards interest because you still owe most of the original loan. But over time, as you pay down that loan amount, the amount that is going toward interest goes down and more of your payment goes towards principal. And that part of the equation, paying off principal, is how you build equity. This chart sums it up well. You can see that during the beginning of a loan payment, most of your payment is going towards interest. But towards the end, really in those last 10 or so years, this switches, and most of your payment then starts going towards equity. But this is where things get dicey. So the average homeowner stays in their home for just over 12 years. Let's take a look at how this scenario would play out today. So let's say a person takes out a 30-year mortgage on a $500,000 home. Assuming the standard 20% down and 6% interest rate, their monthly payment would be about $2,400. After 12 years in the home, they've paid off nearly $94,000 in principal. They've also paid over $280,000 in interest. Already seems wild, right? Now imagine someone else making the same purchase, same rate, but instead choosing to spread their mortgage across 50 years. Their monthly payment decreases. It goes down to $2,100, so about $300 less than the 30-year option. But after 12 years, they've only built up $25,000 in equity, but spent $304,000 in interest. That means that in those 12 years, the person with the 30-year mortgage has built nearly 4 times more equity. If we play things out over the lifetime of the loan, the person with the 50-year mortgage ends up paying over $400,000 more in interest. To me, it seems like a pretty bad trade for a payment that's only $300 less each month. And realistically, this example assumes that the banks would even charge the same rate in the first place, which is highly unlikely. With a longer repayment timeline, banks are taking on more risk, and that would likely drive rates up. But all of this is missing the bigger picture issue. The White House says it wants to help fix the housing affordability crisis, but the issue with the housing market today isn't that homes are difficult to mortgage. It's that there aren't enough of them in the first place. We're dealing with a supply and demand issue. There aren't nearly enough homes for the number of people that want to own them, and that has driven prices up. So if you suddenly make it easier for people to borrow, but you don't build more homes to actually match the need, you're just injecting more demand into a fixed and very short supply. And that means higher prices, not more affordability. We've seen this play out before. For example, the 7-year auto loan has become increasingly popular as car prices have gone up, and Americans have started to hold onto their cars for longer amounts of time. But despite these longer loan terms, auto loan delinquencies have increased, and the average price of a new car is now nearly $50,000 compared to $39,000 for a new vehicle 5 years ago. That's about a 25% increase in just 5 years. We've also seen this with student loans. These were originally designed to be paid off in 10 years, and now there are multiple options that extend repayment out to 20 years and essentially keep borrowers trapped in a never-ending dance of minimum payments and snowballing debt. With options to finance even a taxi for your burrito, Americans now have record amounts of consumer debt. If we really want to make housing more affordable, what we need are 2 things. First, we need to build more homes. A 50-year mortgage would do the opposite of helping with affordability. All it'll do is drive prices up by introducing more buyers into a market that's already struggling with short supply. And the second thing that we need is we need to become more mobile. Americans are moving less than ever before, and some of it definitely has to do with how expensive housing is, but part of it is also preference-based and opportunity-based. More people than ever are living in cities right now, where it's also the most expensive to build new housing. Fixing the housing supply is likely going to require a lot of housing in suburban places, and we have to find a way to encourage both businesses and people to be able to go where those more affordable homes can be built. Last year, the average age of a first-time homebuyer was a whopping 40 years old. Young Americans are pretty much locked out of homeownership right now. But the 50-year loan is not the solution. In today's housing market, first-time homebuyers would essentially be paying off loans into their 90s. By the way, the average lifespan in the US is 79 years old. 50-year loans are not a solution to affordability. They're just another way to put people in debt for a lifetime. But here's who does benefit. Longer-term loans benefit banks who profit off of compounding interest for decades longer than today. And number two is real estate investors like me, people who are already in the game and get increased cash flow and leverage that they can use to just snap up more property. But for everyday people trying to build wealth through homeownership or just have a stable place to live, it just rigs the game further. The 50-year mortgage risks turning their home into a lifetime of liability instead of a stepping stone to financial freedom.